reading in your notes, I was reminded at the intensity with which the Fed raised rates. If you take a look at the 5-year chart of the Fed funds rate, you can see they started with a little 25 basis point, but then went 50, 75, 75, 75, 75, and then 50 again. So huge leaps there. Do you think we're going to see the same kind of intensity on the way down?
It's funny, Matt, we look at what the Fed funds future, thank you for having me, the Fed funds futures are telling us. And it's so silly because if you look back in the beginning of the rate hike cycle, when they started raising rates in 2022, they had only assumed that the market had assumed that the peak rate would be 75 basis points. They ended up doing 4 75 basis point hikes in a row. And somehow we think that a 25 basis point cut, yes, of course it's messaging, but with the 10-year bond yield already down, given the obvious inversion, clearly the market has already discounted a pretty significant rate cut cycle, yet we're still talking about whether it's going to be 25 or 50 when it probably needs to be a lot more.
Well, to that end as well, if you don't see a lot more, Tony, what does that mean to the read-through of the market? Because you saw that sell-off really start to accelerate Friday after those jobless claims. And you have to imagine if rates don't come down fast enough, how that looks a year from now. Where are you seeing the pain?
It keeps us in this zombie-like environment. We haven't seen this broad market surge because we're still in the debate of whether it's a soft landing or it's going to be a recession. We still have the inversion of the yield curve. So all those factors that have kept us there without a more aggressive rate cut cycle keeps us in this I don't know what to do camp. And when that's the case, you have those top 7 stocks or top 10 stocks in the S&P become more than a third of the index, which is historically high, because it's trapped investors in not really confusion, but just so much uncertainty that you got to go with the growth. That's why the Russell 2000 typically and the smaller cap and broader market have responded to rate cuts. But ultimately, we've got to get out of this zombie economy where is it alive? Is it dead? You don't know. And it really, I think that is ahead of us. And it's what the unemployment rate is beginning to message.
Are you worried that unemployment is going to get higher to 5% in a swift manner? I mean, 4.3 is not too bad, especially if it's because of a growing labor market more than layoffs. But if the latter starts to come, it'll be difficult for the market to handle.
Well, Matt, as you know, I mean, we've been talking for a long time. And as we know, the unemployment rate, Goolsbee said it yesterday, the unemployment rate goes up on a rocket ship and down. I say it goes up on an elevator, down on an escalator. You know, the rates have to come down pretty hard because the unemployment rate doesn't go up slowly. That's what I meant. The unemployment rate goes up on an elevator and down on an escalator. Companies don't want to hire people unless they have to, unless they believe that you're losing out on potential revenue. But when the costs get up there and the revenue falls, you can't cut costs fast enough for the revenue shortfall. That's why if you look at company profit margins, and this all ties back to the employment picture, profit margins really collapse during a recession because you can't cut employee costs quickly enough. So when it happens quick. And the signs are there in the last few, not just the last one, but the last few employment reports that were trending toward that rocket ship in the unemployment rate. And ultimately, Matt, I think that's what you got to have to clear out this economic zombie-like environment
Tony,
that I identified.
You know, that saying about going up on an elevator and down on an escalator, I heard the same thing for equities yesterday as well. I'm curious how you handicap where the floor is to this market and how much more downside risk there really is.
I think the craziest thing, Vanilla, is people like me come on TV and say and make a wild guess at that. This thing is obviously yesterday, you're driven by algorithms, you're driven by quants. The day-to-day stuff, I don't think isn't necessarily related just to the macro. It's where the stop levels are. It's where those. So you get these extreme moves. I mean, just look at Japan. Down 12% and then up 10%.
Nuts.
That's telling you that there's something else at play on a day-to-day movement. So what I like to do is step back and say, okay, what direction is the employment picture going? It's worsening. What direction is consumption going, it's worsening. And those are the drivers, really, of the forward-looking economy. So then the question becomes, is it going to be a 2008 environment, or is it going to be like an S&L crisis in 1990? Remember, a recession happens when companies need access to capital, and there's no capital to provide from either the bank or private sources. I think it's the opposite today. The banks are in very good shape and from a capital level. The private equity and private credit side are getting new money in every day. They're just unwilling to deploy that capital for growth until we remove the uncertainty about a forward-looking recession.